Hello there.
Hello everyone, I'm the Gentleman Investor. This week we're up and running. Let's invest. This week we're going to find out who won the battle between Tesla and Nvidia. We're going to have a portfolio update and we're going to find out which two stocks are battling each other. Without further delay, let's get underway. So Tesla and Nvidia fought it out last week, and although it was a real struggle, I've been able to add up my wife and my votes, and the winner was Tesla. Let's see if we can get a third person to vote next week. So let's make our first investments. I'm super excited. Okay, so Tesla won, and in hindsight it wouldn't have been the end of the world if it had been Nvidia. Their stock's taken a massive fall this week with a potential antitrust lawsuit. That lawsuit notwithstanding, I think I'm happy to be investing in Tesla around this $200 mark. Let's hold fingers for a big robotaxi, Optimus or SpaceX collaboration supercar announcement. So that was £25 into each portfolio. Our subscriber count is a grand total of 1. Let's get that to 1,000 subscribers and a £26 investment. Let's see how our portfolio's got on this week. Not too exciting yet, but we're seeing the first blips of investment. Well, I find it exciting at least. And there's a little bit more going on in the Battle Royale tally. Tesla versus Nvidia, 2 votes to none. The winner, Tesla. And this is what our portfolio looks like. We're beating the market at least, and that looks like a pretty healthy portfolio. Apparently it's a growth portfolio. I think there are a lot of people who will have a few comments about whether Tesla is growth or not, but that's a conversation for another day. And finally, we've got some statistics for our income generator. The next payment is a whopping 16p, with projected winnings of 30p. But the graph doesn't look too bad. And in March it's going to go up to 14p, 31p in June. September we won't talk about as it's just passed. And in December there's our 16p.
3, 2, 1, fight!
This week's theme is UK companies with huge earnings growth. Why UK companies? Well, I think the UK market is really good value at the moment, and on top of that, you don't have to pay any withholding tax. Well, provided you live in the UK, that is. Now, those 2 reasons alone might not be good enough to invest exclusively in the UK. But hey, they're good enough for this week's stock theme, that's for sure. In addition, as a UK-based investor myself, and more particularly as a gentleman investor, I would like to support our UK market and would love to see more investments into the UK. Are we going to see any governmental and regulatory supports to make the local London Stock Exchange a more attractive place to invest in and list? Well, only time will tell on that one. There are many ways to pick a good growth stock. For example, one could start by looking at the story of the company and what you think its future is going to look like. You'd take into account what you think the macroeconomic picture will look like in the coming years too. You should also take the stock's historic growth into account and look at what its earnings per share has been doing. Consider how its products or services are faring by looking at the gross margin, and seeing what it does with its money by looking at the return on invested capital. If you consider all of these factors, you're well on your way to finding a company that may well be poised to grow well in the future. Finally then, you should also check the capital size of the company to make sure it is not insignificant, and check that its recent sales and profits aren't falling, and that it's had a successful growth period so far. So clearly, one of the very important parameters there is earnings, and more particularly earnings growth, which is why this week's theme is huge earnings growth. I found 2 companies that have had very successful years. JD Sports showed an earnings growth of 188% last year, and Tesco grew at 166.5%. Now, as we all know, past performance is not indicative of future performance, so it's good to see that, according to Simply Wall Street, JD Sports has a forecast growth of 15.87% per year, and Tesco a forecast of 3.08%. So you can see that the future growth estimates aren't as high, however. Both companies are in a good position to take advantage of the huge earnings growth from last year, putting them in a very good position for the future, and it'll be very interesting to see what they choose to do with the funds. Although the high interest rates and pressures on consumers will hopefully ease in the coming years, I think both of these companies are well positioned to continue their success into the future as discretionary spending increases for consumers. So that's the argument for both. The question remains, which one should we invest in? And my suggestion is Tesco's! Tesco is the more established company with a bigger market cap and will perform well as the consumer feels more able to spend over the coming years. I think that a lot of business will swing back from the budget retailers back to the likes of Tesco, while at the same time Tesco is too far at the up end to be impacted by a slower than expected ease to the cost of living. Tesco also pays a nice dividend, which, although not the focus of this battle, is nice to see for a long-term investor. And the final reason? Well, they do say to invest in what you know, and I'm a Tesco shopper. I like their club card and benefits we get from doing a weekly big shop with them. I like how much of a one-stop shop it is. We get our fuel there too, and I'm even loving their new clothing range. I definitely think this company is one to watch for the future. Do you agree with me? Which company would you invest in? And have I missed any? Please let me know in the comments. Thank you so much for watching, everyone. See you next week.
Goodbye.
Vote for your share in the comments.